Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but also protecting our capital. One thing that blows me away, can you believe Barbie has made $1 billion at the box office? I can't believe it. It'd be a cold day in hell before I see that movie. I just can't wait for football season, guys. The stock market. We've been looking for 5 to 10% pullback in the markets, especially as we're entering the seasonally worst period for the market in terms of August and September, especially September. The market was down 2.3% last week. Could this be the start of the correction? So here, over here to the right, this is uh, the 20-day moving average, the 50-day, 100-day, and 200. So to technically get a change in the direction of the market, you got to break through this 200-day. So we think it's probably just a correction that's coming at this point. We broke the 20-day. So next stop is the 50-day, which is 4,400 on the S&P 500. We're roughly 4,500. You should be aware of this, maybe a little bit concerned. Take some profits. We did this last week. The concerns that we have on the fundamental nature are the valuations. They're stretched. They're too high. 19 times next year, 20 plus times this year. With the 10-year Treasury yields rising, that puts pressure on the S&P 500. It caps the upside and actually may push it down because it's getting the stock market's getting overvalued relative to bond yields. The inverted yield curve, that's always a precursor to a recession. We have an inverted yield curve. It's been there a while. I don't think there's any question we're going to have a recession probably this time next year. Earnings expectations, they're still too high. I'm going to walk you through that in a second. But we think there's pressure on earnings to come down a little bit more. And the sentiment is way too positive. So all this spells that the fundamentals are not great. We just have to have the technicals to confirm a downtrend or a correction may be occurring. And we have just the initial signs of that happening right now. The 10-year Treasury moving up. So you can see that it's right around that 410 level. It's right at resistance. If this was a stock, I'd be kind of getting excited that it was breaking out. So in terms of the yield, it might be breaking out. So what's happening here? Well, the debt ceiling was passed. The treasuries in the market trying to refill their coffers with cash. So that's pushed yields up. Fitch downgraded the U.S. Treasury notes, U.S. debt last week from AAA to AA plus. So what does that mean exactly? That means it goes from less than a 1% chance of default to roughly just over a 2% chance of default. So basically nothing. If this was heart disease, I'd say party on, right? The 10-year generally correlates well with nominal GDP. So what's happening is that the market is starting to discount that inflation might be higher going forward than what it was the last decade. So we're going to have inflation longer. So nominal GDP is real GDP plus inflation. So that inflation part is probably going to be higher going forward than it has been historically. That'll put pressure upwards on the 10-year Treasury. So the 10-year Treasury is the discount rate for the stock market. If that's going up, then stocks are worth less than what they were before. CPI on Thursday, we don't expect any surprises. So that may be the surprise that there is a surprise, right? That's kind of funny. So the CPI on Thursday, it's expected to be up 3.3% year over year. That's the reported number. But core is still sticky at 4.8%. That's what's expected. So the blue line is the reported. As you can see that it was up 9% a year ago this time, now in the low 3% range. It's coming down because comparisons are getting easier. Basically, that's it. The core is still stuck around this 5% range. So if it dips below 4%, we'd say that's a big positive. It's not going to happen. Gasoline prices are starting to trend higher, still below what they were last year, but they're roughly 60 cents higher than what they were at the bottom at the beginning of this year. Wage inflation has been running above 5%. Historically, it's been somewhere between 2 and 4. So it is the fundamental problem with that core rate coming down. Now, this is kind of interesting. It's kind of fun to watch a little bit. The bulls are always bullish, it seems like. They don't turn. But the bears, some are turning positive. So we think they're going to get whipsawed right in front of a correction in the markets. If you look at what's happening with earnings, so this is the most important factor. So this quarter, earnings were down roughly 4%. Then they'll be flat next quarter on a year-over-year basis, but up 4% sequentially. And then the fourth quarter up 8%, 8% in the first, 12% in the second, and 9%. So you see this nice rising trend in earnings. This keeps the bulls bullish. The bears have quit fighting about it, but the bears have not seen that decline in earnings because the recession has not occurred yet. We think it's highly likely this time next year we will be in a recession. It just takes time for it to occur. Now, Apple, the biggest beast in the jungle, had another disappointing quarter. So Apple, there's pressure on smartphone sales along with their PCs and tablets. Apple's had to go to India to look for growth. So Apple has this problem with law of large numbers. To go to India sounds really sexy, right? Biggest population in the world, now displacing China. They're taking market share from China in terms of manufacturing. However, the median monthly income of an Indian is $330 a month. I don't see how the average Indian is going to afford buying an iPhone. It's going to be a long process growing that market. So law of large numbers is hitting Apple. Apple is the largest company in our stock market. They're not seeing earnings growth. I don't see it turning up anytime soon, even with the iPhone 15 coming. So how many more improvements can they make? We're on phone number 15 now. So I think it's time to take some profits. So take a little bit out of your portfolios. If you're one of my clients, just rest assured we're going to get defensive when we need to. Thank you. Hit like. Come to my website. Sign up for Mark in a minute. I'll send it to you on a weekly basis, a hard copy. Hit subscribe. Take care and have a great summer, and let's look forward to football season.